When we think about index investing, we automatically think of it as being average, boring, just straight out dull. However, I beg to differ, my friend. They're one of the most exciting and powerful investing vehicles available to individuals like you and I. So let me share with you why I think they're so awesome and why they provide you an unfair advantage in today's complex financial landscape. And hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. The number one unfair advantage of index investing: it's higher returns. That's right, you get higher returns with index investing. Now, some of you guys hearing this might be saying, higher returns? That's not true. There are tons of other funds and investments that do better than a simple index fund. And I agree. There is some truth to that statement. However, over the long run, does that truth hold for most other alternatives? The S&P Dow Jones Indices publishes a SPIVA research report annually to compare the performance of actively managed funds against their respective index benchmarks. And what is most interesting about these reports is that while the percentage of actively managed funds that can outperform the index is somewhat acceptable in the short run, meaning there are enough funds that outperform the market to make the pursuit worthwhile, when we extend the timeline, the number of these funds shrink pretty significantly. For example, in 2024, approximately 35% of actively managed large cap funds outperformed the S&P 500 index. Not bad. That is more than a third of the funds beating the market. Most people might be willing to bet on that. However, when we extend that to 5 years, this number shrinks to 24%. It goes from a third to a quarter now. Now look what happens when we extend the time horizon to 10 years. Only 16%. And at 15 years, 10.5%. We're talking about only 1 out of 10 funds being able to consistently outperform the index. The odds have shrunk quite a bit. And while the SPIVA data only goes out this far, my speculation is that as we extend the timeline longer and longer, the percentage of outperformance will only shrink to a point where it is almost impossible to find a fund that consistently beats the market. Bottom line, don't look for the 1 out of 10 fund that beats the market. Look for the 9 out of 10 fund that outperforms the actively managed funds, the index fund. The number 2 unfair advantage of index investing: it's simplicity. The world of finance loves to overcomplicate investing. Complex strategies, complex terms, complex people. And why is this? It's because complexity sells. Complex is sexy, it's appealing, and it makes it seem like there's more to it than there actually is. It's like a fancy magic show. And the sad fact is that most people get too easily impressed by these magic shows that the financial industry constantly puts on. And they end up buying complex strategies and expensive funds in the hope that they can make money. However, this is very dangerous. Albert Einstein once said, if you can't explain it simply, you don't understand it well enough. And in the world of investing, if we can't explain our investing strategy in 1 minute, we essentially have no idea what we're investing in. Well, the beauty of index investing is that because it is so simple, you actually understand what you're buying. And that is its unfair advantage. You understand that an index fund is simply a mutual fund that seeks to track the return of a market index. That could be the S&P 500 index or the total market index. And that is it. Nothing more, nothing less. You get the market when you buy a broad market index fund. And what does this simplicity and clarity help you do? Which leads to the next unfair advantage. The number 3 unfair advantage of index investing: it frees you up from distractions. Unnecessary distractions. The list of distractions that investors are forced to deal with never ends. The economic news, latest tech trends, the hottest companies, best performing stocks, new fund rollouts, market predictions, and your coworker bragging about how you made a killing in the latest investment. And when we don't have a grounded investing strategy, all these distractions will take us here and take us there, down a rabbit hole of fruitless search for the holy grail that does not exist. But just as we know that achieving results require focus, not distractions, the same principle holds true when it comes to investing. If we want to have investing success, we must ignore distractions, all the unnecessary noise. Well, when we follow an index investing strategy, because we know beating the market is near impossible, and the simplicity allows us to actually understand what we're invested in, we're better grounded to be able to ignore distractions. Noise that take our precious resources away from building wealth. We're able to focus on what truly matters, which leads to the next unfair advantage of index investing. However, before we get there, I want to share with you a free gift that will come handy in your investing journey. Whenever we watch videos like this about investing, one of the main questions we have on top of our mind are, how do we implement them in our own life? Does it align to my investing strategy? Actually, what is my investing strategy or plan? Well, if you have those questions running through your mind, you're in luck, my friend. By answering just a few questions in this investor assessment quiz, you can receive a free, customized investing plan. It will not only show you what type of an investor you are, you'll also get a sample investing portfolio, plus tips to make sure you stay on track to meet your investing goals. So make sure to go to the link I'll have in the description below to receive your free investing plan. Alright, with that said, let's get back to the video. The number 4 unfair advantage of index investing. When we're free from distractions, it also gives us the freedom to focus on the most powerful levers. Levers that are within our control and actually help us to build wealth, not take us away from it. There are a lot of activities within the economy and the world that moves the market. Tariffs, interest rates, new technology, new policies, wars, unpredictable global events. You name it. They happen all the time and they move the market like a roller coaster. Up, down, sideways. And if we have money invested in the market, many of us can't help but constantly monitor these activities and ponder how we should tailor our investment strategy. But the honest truth is that all these activities are pretty much 100% out of our control, so there is almost no economic value to monitoring them and making decisions off of them. New events will occur tomorrow and the day after, and we cannot anticipate nor strategically respond to these events. And we don't want to spend our precious energy on elements that are out of our control when it comes to investing. Well, when you follow a simple index investing strategy, you're essentially embracing that fact. And this allows you to focus on the factors that are within your control, the most powerful levers to wealth building. 1. Your career capital and your income. If you want to make money in the market, you must first have the money to invest in the market, and that starts with a strong income. 2. Frequency. How often you invest in the market. Consistently, dollar cost averaging over time, not trying to time the market. 3. Length of time. Holding as long as possible, regardless of what the market is doing. And 4. Asset allocation. If you're nearing the withdrawal phase, monitoring your asset holdings and allocation, and rebalancing as necessary. These are the key levers, the most powerful levers within your control that can help you build wealth. And when you follow the index investing strategy, you're free to focus on them, not on distractions. The number 5 unfair advantage of index investing. You are free from unnecessary risk. There's a lot of risk to investing in the market. The risk of market tanking tomorrow. The risk of market not recovering for many years. The risk of unexpected global crisis or economic shocks. And that is the nature of the game. If you want to reap the reward of appreciation, you have to pay the price. However, that doesn't mean we have to blindly accept all risks. There are risks that we can't control, but there are risks that we can control and mitigate. And that is the unfair advantage that index investing provides. It essentially eliminates unnecessary risk of investing in the market. Unnecessary risks that are built into most expensive actively managed funds. Here are a few common ones. 1. The risk of having an incompetent fund manager. One who is horrible at selecting the right stocks and who is worse at timing the market. Why are we paying someone ridiculous amounts of money for incompetency, right? 2. Strategy. Let's say the fund manager is relatively competent, but they're pursuing the wrong strategy at the wrong time. They pursue a heavy small cap weight strategy when that is not what is working at the time. Well, with a broad market index fund, this risk is eliminated because no one is trying to pick and choose a specific strategy. Small cap, mid cap, value stocks, growth stocks, etc., you buy them all. Or 3. Duration of the fund manager. Let's say you have a competent fund manager who has beaten the market consistently. Well, who is to say that individual will continue to stick around? No one lives forever, and no one stays at a single job forever. What happens if that individual takes a better offer or retires? Again, what is great about index investing strategy is that all these unnecessary risks of investing in the market are completely eliminated. Unfair advantage. The number 6 unfair advantage of index investing. It is easily scalable. With most other investing strategies, say that be investing in actively managed funds or even non-traditional strategies such as private investments or real estate, scaling is often not so straightforward and many times hard to do. While most actively managed funds do not have a cap on how much you can invest, if it is a specialized fund, you're putting yourself at a high risk by overweighing your portfolio in that one fund. If you want to scale, you often have to find other funds that can help diversify your overall portfolio, which requires more work and more management. And what about private investments such as private equity funds? They typically have limited window to raise capital, thus they're often known as closed-ended funds. Once the funds are raised, the window closes and no further money can flow in. So if you have more capital that you want to invest, you have to find other assets. Real estate is another example of another hard to scale asset. Unless you're buying simple REITs, if you're investing in individual properties, in order to scale, you have to physically buy more properties. And that takes tremendous amount of work and time. Identifying, closing, renting, managing, etc. Well, when it comes to index investing, scaling is very easy. Whether you have $10 or $10 million, the process of investing is the same. You just buy more shares of a simple, low-cost broad market index fund. So easy, even my 5th grade son can do it. The number 7 unfair advantage of index investing. Lower taxes. Smart investors are always thinking about how to minimize taxes because they can take such a big chunk out of our wealth if we allow it. Well, when you follow an index investing strategy, so much of tax optimization is already built in. Let's go over a few reasons why. 1 is due to its low turnover. Index funds simply replicate a market index, thus they rarely buy or sell assets. The only time they buy is when new companies are added to the index, and the only time they sell is when companies are removed or their weight in the index changes. Thus, less trading means fewer taxable capital gains distribution. Actively managed funds, on the other hand, often have a lot of buy and sell activities, which lead to more taxable events. 2 is due to a higher proportion of qualified dividends. Funds, like total stock market index funds, not only produce minimal dividends, most that are produced are qualified. Qualified dividends are dividends that meet criteria to be taxed at capital gains tax rate, which are lower than ordinary income tax rate for most people. The maximum tax rate for qualified dividends is 20%, whereas the maximum tax rate for ordinary income is 37%. And number 3, this is not directly tied to the index fund itself, but still worthwhile mentioning: long-term capital gains tax rate. Most index investing encourages long-term holding, more than 12 months. Thus, when you hold an asset for more than 12 months, you get to qualify for long-term capital gains tax rate. This is lower than short-term capital gains tax rate, which is essentially ordinary income tax rate. Bottom line, index investing has a built-in tax advantage, which gives another unfair advantage. The number 8 unfair advantage of index investing: lower expenses. And this lower expenses is most often reflected by what we call lower expense ratios. Expense ratios are the annual fees charged by the funds to cover management, admin, and operational costs, expressed as a percentage of your total investment. Because index funds simply track a market index, rather than hiring an expensive manager to actively select stocks, their expense ratios are significantly lower, often just a small fraction of those charged by actively managed funds. Let me show you the craziness of the high expenses in action. GALLX, Goldman Sachs Enhanced Core Equity Fund, is a fund I found listed on Morningstar with 4 stars in Morningstar Medalist rating, which is pretty good. However, what is not so good is its expense ratio, a whopping 0.93%. That is $93 for every $10,000 invested. Now let's take a look at another fund, but this one with a very low expense ratio, FSKAX, the Fidelity Total Market Index Fund. This is an index fund that represents the total US stock market and has an expense ratio of 0.015%. That is $1.50 for every $10,000 invested. $1.50 versus $93, that is a big difference. More than 60 times the difference. Well, this Goldman Sachs fund must have something up its sleeves to charge that much, right? It states that its objective is to seek long-term growth of capital. So let's look under the hood at GALLX's top 10 holdings. You have a good amount in Apple, Microsoft, Nvidia, Amazon, Meta. What is funny is that when we look under FSKAX and take a look at its top 10 holdings, what do we have? Apple, Nvidia, Microsoft, Amazon, Meta. Slightly different order, but essentially the same. So the big question is this: if I was invested in GALLX, what am I paying 60 times more for? In this case, and most other actively managed funds case, not much. Index investing strategy gives you pretty much the same exposure at the fraction of the cost. Unfair advantage. The number 9 unfair advantage of index investing: convenience. Today, index funds are very easy to access and very easy to buy. Though Vanguard kicked off the index fund revolution, today it is offered by pretty much all major investment firms: Fidelity, Charles Schwab, BlackRock, State Street, Invesco, T. Rowe Price, JP Morgan. They all understand how popular index funds are, and they don't want to be left behind. Thus, when you log into most employer-sponsored retirement plans, there is often an index fund option. You might need to scroll all the way down to the bottom to find it, but it is there nonetheless. And to buy it, you simply select your choice of fund and you're all set. Well, can we say the same about other investments? Some may be just as easy, but there are tons of other that require a bit of hoop to get through. With private investments, you usually have to work through a broker. And depending on the type of investment, tons of paperwork you have to sign before being able to participate. How about real estate where you hold individual properties? You have to physically select, buy, and manage the property. Yes, there are other means to invest in real estate such as real estate funds or syndicates. However, even those require a bit more jumping through hoops to get in. Bottom line, index investing, especially today, is so easy and convenient to execute, you almost have no excuse not to. The number 10 unfair advantage of index investing: peace of mind. The best investing strategy isn't the one that makes us the most money, but the one that we can stick with for a long period of time. One that we feel confident about and we believe in. And I'll be honest, from a financial perspective, there are tons of other investing strategies that might be better than a simple index investing. You can flip real estate. You can invest in startup companies. Or you can trade digital coins. No judgment here. If it works for you, all power to you. However, if I was to make a guess, most of you watching this video probably don't have the time, the desire, or the emotional energy to pursue that route. You just want a simple strategy that will provide the best future for your family. And I believe that index investing is that simple strategy. As we talked about so far, it is simple, it is efficient, and it is as transparent as you can get. And when we follow an index investing strategy, we don't struggle with regret, because let's be honest, there's not much variation you can have with this strategy. And it eliminates so much stress because we know what we're buying. Additionally, we know we're as tax efficient as we can get, and we know we're buying them for the lowest possible cost. At the end of the day, we invest so that we can live our life, not the other way around. We don't live our life so we can think about our investments all day long. None of us are going to be thinking about our 401k balance or value stocks on our deathbed. And that is why I'm such an advocate of index investing, because it provides that unfair advantage, built-in peace of mind. Thank you guys for watching The Line of Index Funds and Investing. If you want to avoid some of the worst investing mistakes, please check out my video here. Until next time, all the best.